We're going to talk credit and debit spreads. You guys asked for it, so we're going to cover it now in this video. If you are seasoned in options trading in any way, shape, or form, you don't need to watch this video. It's really not going to be useful for your time. However, if you're kind of new to options or you're interested in them and you don't quite know what a credit or debit spread is, this is going to be really useful for you. We're going to get into that now. If you do follow the channel, just generally speaking, you watch the videos and you're interested to know what I'm working on, what I'm theorizing, the research that's going to come out, then either stay till the end or skip to the end because I'm going to cover that at the end of this video. So the first thing is, let's get into it now and open up this trusty Excel tool, which has been with us and the channel for about 2 years now. And a lot of people love this tool. So let me just tell you first off, you don't need it. I'm just using this as a way to explain how options work so you can graphically see the profit and loss payoff of an option in combination with other things, other options or whatever in this tool. So it'll actually click and make sense to you how a vertical spread, a credit spread, or a debit spread works and what it actually is. So I'm just using this for teaching purposes. If you do want the tool, you can go and download it at Crypto Wizards. Just download it, pay for 1 month, go and cancel straight away. Whatever you want to do, that's fine, but you don't need the tool. Let's get into it. So the first thing we want to do is go and place a pretend trade. So in this window here, I'm going to select position 1 and I'm going to buy an option. And I'm going to buy it because I've selected buy over here, and I'm going to buy a call option. Now, what is a call option? What does that mean? Let's do a quick recap or a crash course for anyone who's new to this. Let's say that you own a house and I'm in the market to buy a house. And I think in this market that we're in right now, house prices are going to skyrocket upwards, which, by the way, is not my reflection of what I think about the markets today. Just saying. But let's say that that's what I believe is going to happen. And I want your particular house. So I come in and knock on your door and you say, how can I help you? And I say, I'd like to buy your house. And I'd like the right to buy your house at today's price, at the market price today, a year from now. And you might pause for a second, and if you thought about it, you'd think, well, I'm not sure about that because, number one, what if the house prices go up? Then you lose money because you would have to sell your price to me at today's price, but the market price tomorrow is worth more. So here's today's price, here's what it could be worth tomorrow. Why would you do that? Well, if I said to you, I will give you 10 grand today, let's say your house today is worth 200 grand. And I say, look, I will give you 10 grand today for that right to buy your house a year from now at today's market value. Would you take it? And then you might think about it and say, well, what happens if the house prices go down or they stay the same or whatever? And I say, you keep the 10 grand. So we enter into a legal contract. We get a solicitor there and everything. We enter into a legal contract that I have the right, but not the obligation. I don't have to do it. I have the right to buy your house from you at today's market price a year from now. Now, in the world of the stock market and crypto, etc., you don't have to bring a lawyer in, etc. These are legal contracts traded through exchanges, etc. However, what's important to note is the contract itself becomes worth money or becomes worth less. Here's how I would explain that. Let's say 8 months from now, the house prices have skyrocketed. They've gone from being 200 grand in value, or your house has gone from being 200 grand in value to 300 grand in value. Well, I bought an option contract for the right to buy that house at 10 grand. That legal contract I could sell to someone else and give someone else that right. I could pass it on to someone else. That contract is worth money because house prices have increased by $100,000. So I already have the right to buy it at 200 and the house prices today are 300. So the option contract surely has to be worth at least this change, this gap between the two. Now, take that with a pinch of salt because there's things like volatility, time to expiration, all these things that come into an options price. The point is though, that 10 grand option is going to be worth a boatload more money because the house prices have gone up. Now, let's say the house prices drop to 0. Well, your option is worthless. It's worth nothing. So you have a huge potential reward for making money in the markets, in the housing market in this example, just owning the contract, you don't even have to buy the house. You could just buy and sell the contract itself. And this is why there's so much money traded in derivatives in the financial markets. I believe a huge portion, if not the majority of debt and monetary flow out there is actually in the derivatives markets, options and futures being derivatives. Now, the difference between a futures contract and an options contract primarily is that with a futures contract, there is an obligation to exchange on that house or oil or stocks or crypto or whatever. On a options contract, there is not. So I really hope that that helps to cement in what options are. Here, we're going to pretend that this is a stock or a crypto, and we're going to continue placing our trade. So let's say that the price of this crypto or stock today is worth $7,000. And I want the right to buy it at $7,000 in the future, just like with the house price example. And so what I'm going to do over here is I'm going to say, okay, I want this by 2020 December, I don't know when the expiration dates are, but let's just say the 23rd of December. I want between now and then the right to buy this crypto or stock at $7,000, and it's priced $7,000 today. Now, one very important thing to note is that the volatility of this right now is priced in at 50%. And you need to know that volatility has a lot to do with options prices. You can make money buying an option that favors you both ways, i.e. you make money if prices go up and you make money if they go down, but you lose money if they stay the same. However, if volatility changes a lot, you can actually make a lot more money and you can arbitrage essentially volatility. So here I'm going to add position and I'm just going to move this out the way for a second. Now this is very interesting. I have a payoff chart. This is us now fast forwarding into December, into the future at expiration and seeing, okay, how much money have I made or lost? Well, I have a fixed loss if the price is below $7,000 because I paid $889 or $890 for this option. How was this priced? Well, this is priced using the Black-Scholes options pricing model, which is pretty much how options pricing works today. But this is essentially how it gets priced. There is Black-Scholes who put together this formula that takes into account time to expiration, volatility, the stock price today, or whatever asset price today, what the exercise or predetermined price is, all of that, takes all of that into account and says, hey, this is what you should pay today. If the house price is 200,000, it's the model that would tell you you should pay 10 grand for that option today. That's how I know. So if the prices go down, then I know I make a fixed loss because this is everything I have to lose. If I give you $890 today, that is what I will lose if prices move against me. I don't need a stop loss or anything. However, if prices move, say, above just under this $8,000 mark, here I make an unlimited amount of profit. Now, let's say you're the person who sold this option. So I'm just going to exit this window for a second. Let's say you're the seller of this option. So what I'm going to do is go and change this to sell, as though we're actually selling it, not buying it. Well, if I'm the seller of this option, I get the opposite of that. You can see how the payoff chart actually reverses. So over here, I make a fixed income, which is what the buyer of the option would pay me. But as the prices of this asset go up, we lose an indefinite amount of money, which is scary. So be very careful with options. Make sure you know what you're doing. But right now, we're going to be the buyer of this option, which is great because I have a fixed loss and I can make money pretty much to an unlimited degree. So when I look at this, I say, well, what's the advantage of this? Well, number one, having this fixed loss here is great because if I have this fixed loss over here, I don't need a stop loss or any of that kind of jazz. I can just let this play out, meaning that if the price of this asset was to plummet over here, well, I've lost $890. But what happens if it then skyrockets up again? Well, then I'm in profit. Now, this depends a lot on what happens with volatility as well. Let me show you what I mean by that. If I say, let's say that the volatility here is 50%. Let's actually say that when we buy this option, the volatility is actually 80%. You'll see that that changes the payoff because the option becomes more expensive. If the volatility is only 20%, then this looks a lot more favorable. However, because the volatility is lower, the price is likely to move lower. So it's unlikely that you're going to get up in this range. So volatility plays a huge part in this. Take that now again with a pinch of salt. Well, actually don't, because volatility does, it plays a huge part, but just park it for now because we're going to come back to that in a second. So let's go and set another position now. So I'm going to set a second position. And actually, before I do that, I'm just going to hide this position. I'm just going to put this to none. So we're going to be neutral again. And I'm going to set a position here where I am going to sell an option. And it's going to be a call option again. The price today is $7,000 because I'm placing both trades at the same time. And I'm going to change my exercise price. So I'm going to say, rather than buying your house at 200 grand, please, sir or madam, I will actually buy it at 220 grand. And you might say, well, that's great because you're actually offering me a contract to, or essentially we're entering into a contract where you're prepared to pay more for my house than it's worth today. Well, the reason why I would do that is if I believed the market was going to explode upwards, the price that I could pay or that you would charge me for this contract would be a lot less than 10 grand. You'd be like, yeah, I'll give it to you for like $500, right? So now I don't have to pay 10 grand. I'm risking a lot less. And my potential gain is huge because if the housing market does move past, even if it reaches actually that current housing price, so the 220 grand, or not the current housing price, but the exercise or the strike price that we agreed that I would have the right to buy it at. So today it's worth 200 grand, 220 grand is the future price. Let's say it actually moves to that. My options contract has now become worth a lot more money than $500. So I make a lot of money on that. Now be careful here because a lot of people think they can just go about buying really cheap options and retire on that and make a boatload of money. Just remember that there's a probability factor here and that markets are largely random and they move in the normal distribution. If you haven't watched the series, the most recent one on how to predict markets, watch that because you won't get fooled so easily like a lot of other folk. You'll see a lot of videos. I see them sometimes on the feed on YouTube popping up where people are talking about ridiculous amounts of money that they've made trading options. Yeah, statistically that will happen occasionally, but over time, it's quite likely that if they don't really understand what they're doing, they're going to lose a lot of money. So here, let's say that we want to do this. We want to go in at 8,000. So I want the right to buy this stock or crypto at $8,000, even though the price today it's worth 7,000. I should pay a lot less for that. So here I'm going to go to 2020, December 23rd. And in fact, we said we were going to sell this. Right now, I'm just going to say buy it just to make it understandable. So I'm going to add this position in and I'm going to exit this. And you can see the payoff chart looks largely the same. However, if the price is under 8,000, in fact, if it's under $8,500, I lose money. I lose this fixed amount, this 520. And actually, we went and we placed this buy here in position 1. I meant to do that in position 2, but it doesn't matter. We'll fix that in a second. So you can see here that the payoff chart looks the same, but now if I'm the net seller of this option, I take in an income of $500. I'm taking in less money because when this was at $7,000, I would be able to take in $890. Now, when it's at $8,000, because of that scenario I mentioned earlier with the house, as the seller, I'm taking in less money. So anyway, let's switch this back to buy. Let's put this back to $7,000, which is the payoff chart. And here the seller is selling me the option at $890. So this is the maximum loss I have. And now we're going to add this position 2 in where we're going to sell that call option at $8,000. In other words, taking in as an immediate income that $500 mark with an expiration date of December the 23rd. Add position. And I'm just going to exit out of this right now. Now look at my payoff chart. This becomes really interesting really quick because I have a fixed amount of gain and a fixed amount of loss, pretty much. Now there's this small bandwidth over here, depending on if the price landed here or here or here. It's not quite fixed. It's a little bit variable. But anyway, the point is that we make fixed gain or loss here. And it's more of a binary event. It either ended up high or ended up lower, and I can take these fixed incomes with this fixed amount of risk, which is really interesting. The other thing you'll note is my potential top payoff amount, maximum payoff is $600, and my potential maximum loss is just under $400. So my risk to reward is actually really favorable. Now, because I'm buying a more expensive and more useful, I would say, in a sense, option than what I'm selling. So I'm buying a more expensive option than the one I'm selling. This is called a debit spread. Now, let's do something really interesting. So this is a debit spread because I am the net buyer in this example. I'm buying something which is more expensive than what I am selling to cover some of that cost at. Let's say we swap this over. Let's say I become the seller of this option and the buyer of this one. Well, the payoff chart just flips over. That's all that happens. The payoff chart just flips over. And this is more of a credit spread because in this instance here, I am the net seller of the more expensive option, meaning I'm taking this income straight away. Let's just hide this for a second. So I'm taking this income, this $890 straight away. And then let's hide this one and look at position 2. Here I'm buying this one here at less. I'm buying it at $500. So my maximum loss here is less. And I have this potential reward. When you add the two together, you get this chart. And if I swap them around for a debit spread now, I get this payoff chart. And so welcome to credit spreads and debit spreads. So I just very quickly wanted to talk you through, just for a second, why is this really useful? Like, number one, we already spoke that we have a fixed loss and a fixed gain. I know my entries the minute I get into them. I know my probability of profits. I know how much I'll make at a maximum, how much I'll lose at a maximum, etc. And I'm going to show you that on an actual broker platform in a moment. The other thing here is, when would I choose a credit spread over a debit spread? Well, if I believe that volatility is going to go down, and the implied volatility, if you don't know what that is, there's so many videos on YouTube that do it. If you really want me to do one, if you'd rather I explain the implied volatility, please, again, just put in the comments implied volatility, and just like this video, I will do one for you. However, there's a lot of good material out there on implied volatility. If I believe that volatility is going to go down, then I want to be the net seller of an option, because if that volatility is higher, then I take more money in when I sell that option. So for example, here where I'm selling an option, if I'm selling it at 80% volatility and I'm buying it at 50, I make guaranteed profit no matter what happens. It's almost like an arbitrage. And this becomes really cool. Volatility is what you want to trade here when you're looking at options. So this becomes really, really interesting. Now, one thing I can do if I really want to is I can add another set of legs to this. So I could add it on the put side, which would be really interesting, because then you have something like an iron condor or butterfly or whatever. Just remember though, the reason why I like to just keep to 2 trades is because there's a bid and an ask spread on every single option that you're going to trade, right? So the more options you add, the more risk you're adding in terms of your income, because essentially there are more spreads that you're paying to get into that trade. So for example here, let us place a trade. Let us say that we are going to sell right now. So here's the SPY. I'm going to sell, the price is at 336, which is here at the money. I'm going to sell an option at the money, and I'm going to buy one here slightly out of the money. Is that a debit or a credit spread? Well, because I'm selling one more in my favor, it's actually a credit spread. If I go over here to the payoff chart, you can see that's what we see. We see this here. I go back to my table and I actually delete that, and I delete that, and I rather buy this one and sell that one. So I'm buying a more expensive one and I'm selling a cheaper one. You can see the price differences on these options. This is the cheaper option. You can see it's essentially reversed, and I can move this around. This is why I love the Tastyworks platform. It's so cool. It's a lot more user-friendly than Interactive Brokers, but it's a really, really cool platform, and you can see how I'm playing around with that here. So when you go to an options chain, that's essentially what you're doing. You're trading this vertical spread. So you're buying on the same side. You're either doing calls or you're either doing puts, and you're essentially either buying a more expensive one or you're buying a cheaper one. If you're buying a more expensive one, you do it if you think volatility is likely to go down from what you're paying today. If you're buying a cheaper one, then volatility is probably quite low to what it usually is, and you think it's going to go up. So welcome to credit spreads and debit spreads. If you're a seasoned trader and you've watched this and you think I've missed anything or got anything wrong, please let me know. This is the way I like to understand it. And so I want to just finish off talking very quickly about the channel. So some of the things I'm interested in right now, I'm thinking about correlation of different markets. All markets are expanding because of money flow. And one thing this whole COVID scenario has really highlighted to me is just how important it is to really understand the money flow in and out of different markets. If you were like me involved in the crypto boom back in 2017 to 2018, December 2017 actually, then you'll know what it's like when money gets pumped into a market and then sucked out. Right now, we can see crypto prices are doing very favorably. Money is getting pumped into the market, but so was gold, so are stocks, etc. Things are correlated because of money flow right now. And that's not always the case. The markets aren't always going to behave the same way in the same type of unison as they are right now. That's going to change. And so what I'm very interested in doing at the moment is looking at the correlation between different markets and what markets you might want to enter into based on how well correlated they are at that point in time. I'd also like to thank some of the viewers of the channel who prompted me on co-integration again, and especially my cousin Jacques, who also prompted me on co-integration through a message. And he sent me a really, really interesting, by the way, if I've not introduced my cousin before, my cousin is a genius, and he sent me a really interesting paper on co-integration in crypto written on Medium. And so I want to really look into that as well as the correlation side. I'm also learning about reinforcement learning. I'm learning how to code and program that. It's happening slowly because, my day job, I'm very, very busy in what I do day to day. And there's a lot of things there that are, high pressure and I need to prioritize. But what I'm looking to do is to see, can I get a machine learning algorithm to essentially learn how to trade based on different markets, correlations, and the prices that it can essentially arbitrage in those environments. And to build something that complex, you really need to understand how to build individual things in each of those states very well. You need to understand how to apply reinforcement learning to the stock market very well, etc. So these are the things I'm working on. I don't know when the next videos will come out. I will essentially only post videos on things you guys ask for or things I think are really valuable and interesting, such as the prior series. I hope you found that useful. I look forward to catching up with you in the next video.